we go. Okay. And then once you're in Cengage now, you should just be able to hit start assignment now. So I just put out about 7, some of them are quick, for us to go over together. So we're going to do these exercises together. That way when you're doing your homework, you'll have something to refer back to, and also just to help you kind of solidify what we talked about. I know we covered a lot, right, in chapter 8. We talked about accounts receivable, which we've dealt with before in college accounting, but now we're looking at, you know, what we do when they don't pay or when we think they're not going to pay. So do it.
You said the chapter 8 homework?
Chapter 8 practice. Thank you. So what we're going to look at in chapter 8 is we're going to look at how to handle uncollectible accounts. So we're going to look at the direct write-off method, which again, we can use the direct write-off method if we are not a publicly traded corporation. So direct write-off method is great for smaller companies that are not, you know, large corporations that are publicly traded. So that's the first one we're going to look at. But again, as a reminder, the direct write-off method is not compliant to GAAP, those generally accepted accounting principles. So it's great, again, if we're a small, you know, like proprietor or partnership or even a privately held corporation if we're little, but we cannot use the direct write-off method if we are publicly traded corporation. So we're going to look at that. Then we're going to look at why did my mind just go blank? Allowance for doubtful accounts method. Just like whoosh. We're going to look at that, which is GAAP compliant, like looking at aging accounts receivable. So we're going to take some of that into consideration. And then we're also going to look at notes receivable, since chapter 8 is all about receivables in general. So we'll go into notes. You know, notes are still accounts that are due to us, but they accumulate interest, okay, or accrue interest. So again, this first one, we're looking at the direct write-off method. So for those of you that are kind of newer to Cengage or haven't used Cengage, I'll point a few things out as we go. One thing, anything that's in green, if you move your mouse over it, it'll give you a definition. So if you're in your homework or working in other things, you know, if it's in green, if you just mouse over it, it will give you the definition. So, for example, when I mouse over direct write-off method, it says the method of accounting for uncollectibles that recognize the expense only when accounts are judged to be worthless. So again, direct write-off method, we're just looking at specific people saying their account is uncollectible, and so we'll just write their account off. Again, it doesn't follow the matching principle, but we're still going to look at it. And then again, receivables is in green, so you can look it up. So the very first entry says journalize the following transactions for Canyon River Medical Company, and they use the direct write-off method. Well, this January 19th entry is a review of like chapter 5. So we'll see what you remember, right? You didn't know it'd be quizzed right off the bat. So it says on January 19th, we sold merchandise on account to Dr. Kyle Norby for $6,400. So we made a sale on account, and the cost of goods sold was $3,000. So for that first journal entry, we have to go back to college accounting and think, how do I log a sale? So does anyone remember what the debit and or credit is, debit and credit, when we sell merchandise on account? Yes. Perfect. Yeah, we're going to debit accounts receivable for Dr. Kyle Norby, and we credit sales. And it's for the $6,400. Okay, so we debit accounts receivable specifically for Dr. Kyle Norby. It's his account, and then we credit sales. And then the second part, remember when we do sales on account, we always have to recognize the cost. So it says the cost of goods sold was $3,000. What's the debit and credit for that? Anyone know?
The debit is cost of goods sold.
Perfect. Perfect. You guys do remember, or you reviewed, right? So we debit cost of goods sold. It's absolutely correct. And you credit inventory. Okay, so remember the 3,000 is what we paid for the merchandise. So we're showing it leaving inventory and being debited cost of goods sold, which is just an expense. Okay, so that's a review. The next entry says June 2nd, we received $500 from Dr. Kyle Norby, and then we wrote off the remainder owed on the sale as uncollectible. Well, if I receive $500, what do I need to do? Very good. Yeah, we're receiving payment. So I'm going to start by just debiting cash, $500. This is a compound entry. So we debit cash $500. And then he owed us a total of $6,400. He paid us $500. So how much does he owe that we're writing off? Perfect, $5,900. So we're saying he's only going to pay $500. The other $5,900 we're not going to see from him. So under the direct write-off method, we're going to write off $5,900. What account do I write that off to? Perfect, you guys got it. So I'm going to debit bad debt expense, the $5,900 that we don't think we're going to collect. Maybe he told us, here's $500, have fun. You know, like I'm not going to pay you anymore. Yeah. And then we're going to credit his entire accounts receivable, the $6,400. So that way in that journal entry, our debits equal our credits, right? Because we have cash plus bad debt expense is $6,400. Okay. So when we do a direct write-off, we just credit their account and write off whatever amount we're not going to collect to bad debt expense. So bad debt expense gets debited, and then his account gets credited. Okay. And then on October 23rd, we need to reinstate his account because we received the cash in full. So I guess he decided to actually pay us. So to reinstate his account, what do I need to debit and credit? What do I debit?
The bad debt. Well, yeah, the bad debt.
The bad debt expense gets credited because we're reversing it.
The
accounts receivable. Yeah, you got it. So yeah, we start with, we're basically just reversing the entry. So we're actually going to debit his account, accounts receivable, to place it back on the books for the $5,900. And then we're going to credit bad debt expense to show it really is no longer bad debt, right? He's paying it. So we're reinstating it. And then the second part of that is the next journal entry is just him actually paying it. Okay, so we're receiving cash. So I debit cash, $5,900, and then I credit his account. And again, it may seem silly, right? You think, why can't I just debit cash and credit bad debt expense? But then I'm not seeing on my accounting records what really happened. You know, I want to show that it was his account that was reinstated and then paid off. Because that way I know to stop collections. Okay, so that's why we have to do what seems kind of redundant here, right? We're debiting it just to credit it. But that's the whole purpose there, is we want to show it was his account that got paid in full. So that way we don't send them to collections or we stop collections. Okay. So those are some examples with our direct write-off method. Are there any questions on that one? Okay. So again, it's good to understand how direct write-off method works, but we can't use it under GAAP. Again, as you go through, you can always use the check my work button. It'll show you if you have anything incorrect. And you can do that on your homework as well, okay? Just not on quizzes or exams. But on your homework, you can always use check my work unlimited amounts. I'm going to click next. Okay, the next there. And this is a similar transaction, only now we're looking at the allowance method. So again, an allowance method or using the allowance for doubtful accounts. So what we do with the allowance method is every year at the end of the calendar year or the end of the fiscal year, I guess I should say, we're going to estimate our bad debt for the year. So if our calendar year runs January 1 through December 31st, on December 31st, we're going to do an adjusting entry to say, of all the credit sales or all of the accounts receivable we have in the year, we estimate that this much is uncollectible. Okay, so what that does is it adheres to GAAP. It follows the matching principle because we're matching that expense of bad debt to the year in which the sale was made. Okay, so that's really important. Again, if we're a publicly traded corporation, we have to adhere to GAAP, which part of GAAP is the matching principle. So it all kind of goes together, right? So in this case, we're going to assume we're publicly traded. We use an allowance method. So we're going to go through these steps. It's important to understand that, yes, as an adjusting entry, we put in the estimate for the whole year of uncollectibles. But as we go through the whole year, we can still write off specific accounts because we still want to remove people from our books if we don't think we're going to collect. We just do it a little differently, I guess I should say. So the first thing, that first entry, sold merchandise on account to Old Town Cafe, okay, $18,450. So again, it's just a review. So if I sold merchandise on account, what do I debit and credit? Accounts receivable, and then I credit. Perfect. Okay. So accounts receivable gets debited for the $18,450, and sales gets credited $18,450. Okay. And then the cost of goods sold was $11,000. So what do I debit and credit for that? Cost of goods sold gets debited. Good. Perfect. And inventory gets credited. And that's for the $11,000 cost we paid. Okay. On September 30th, we received $6,000 from Old Town Cafe and wrote off the remainder as uncollectible. Okay. In this case, though, we are using an allowance method. So it's a little different. So we're still going to receive the cash, though, just like we would. They paid us $6,000, so cash gets debited. $6,000. But again, we already estimated for the whole year our allowance for doubtful accounts. So you remember we did that as an adjusting entry as a credit. So that was actually written off. We already wrote off bad debt expense for the whole year. So bad debt expense doesn't get dealt with when we write off specific accounts under an allowance method. Okay? Because if you remember, I don't know, they didn't tell us how much we did. But at the year end, we debited bad debt expense. And we credited allowance for doubtful accounts. We'll just say it was, I want to make sure 30,000. Okay, I just made up a number. Okay, so that was some kind of adjustment at the end of the year going into this year. We debited bad debt expense and credited allowance for doubtful accounts. So allowance for doubtful accounts. Had a $30,000 balance. As a reminder, allowance for doubtful accounts is a contra asset account. So what that means is it increases on the opposite of an asset side. So allowance for doubtful accounts increases on the credit side. So at the end of the year, we made some type of adjustment. I'm just making one up, 30,000. And we credited that to the contra asset account allowance for doubtful accounts. So we've already debited bad debt expense. As we go through the year, this next year, and we identify like Old Town Cafe, they're not going to pay. We want to write off their account. You know, what the remaining, $12,450. That gets debited to allowance for doubtful accounts. Okay. that $12,450 that he's not paying, or Old Town Cafe is not paying, is going to get debited to allowance for doubtful accounts. So what we're saying in essence is, for the whole year, we estimated that $30,000 is going to be uncollectible. Of that $30,000, we're saying $12,450 is Old Town Cafe. Okay, so every time we write off specific accounts, we're going to debit allowance for doubtful accounts. This was the total estimate, and then these are write-offs of specific accounts. Okay, so I debit allowance for doubtful accounts, $12,450, and then I'm going to credit accounts receivable Old Town Cafe for the full $18,450. So again, this is under the allowance method. We've already estimated allowance for doubtful accounts for the year. Okay. And then just like under the direct write-off method though, we can still reinstate and show that account being paid if the client comes back and pays. Okay, so it's, again, on December 7th, we reinstate the account that has been written off and receive $12,450 cash in full payment. Well, when we reinstate, we're reversing this entry here. So we're debiting their account to reinstate it. So I debit Old Town Cafe accounts receivable, and I'm going to credit allowance for doubtful accounts. Okay. So I'm crediting this back, just canceling it out. Kind of cancels it out there because we reinstated it. And then when we receive the payment, it's the same as we did under the direct write-off. Cash is received of $12,450, and their accounts receivable gets credited the $12,450. Any questions on that? Okay. So dealing with allowance method is a little tricky because we're doing an adjustment at the end of the year, and then we're writing off specific accounts as we go through, which is reducing allowance for doubtful accounts as we go. Okay. Sure, there's no questions.
Where did you?
You got it?
Yeah, I got it.
Okay. Okay, well, if there are no questions, we'll move on to the next one. So in this one, we're actually looking at how do we come up with that end of the year estimate. So we're looking at, we need to come up with what we're going to do as our adjusting entry, okay? So in this case, we're going to do what we call an aging of receivables and try to calculate how much we think of our current accounts receivable is going to be uncollectible in the next year. Okay, so basically our goal, so what we're trying to figure out is how much we're going to do this adjusting entry for. It doesn't matter, you know, what method we use. We're going to look at percent of sales in a little bit. When we use an allowance method, this is always the format of our adjusting entry. Okay, we're always going to debit bad debt expense. So we're always going to credit allowance for doubtful accounts. In this case, we're doing what we call an aging of receivables, which is probably the most accurate way of determining an uncollectible amount, okay? So we're looking at what they do, and they'll give you this information. They've set up this schedule, and they basically said anything that's not past due yet, we think is like 1% uncollectible. Anything that's up to 30 days past due, 3% uncollectible. 31 to 60, 12%. 61 to 90, 30%. And anything over 90 days past due, we assume is 75% uncollectible. So they're going to give you this table, and then they're going to tell you the account balances in each of those late categories. So if I scroll down here, all my total receivables for this year at the end of the year are my total balance is $1,124,500. Of that, $607,400 is not past due. Okay, So what I'm going to do is I'm going to just take my 607,400 times 1% to estimate the amount that I think might be uncollectible out of current bills. So what's 1% of 607,400?
$6,074.
Perfect. $6,000 and $6,074. Okay. Then I just moved to the next category. I have 233,000 that is about anywhere from 1 to 30 days late. I estimate that 3% of that is uncollectible. So what's 3% of 233,000? 6,990. Good. In my next category, I estimate that 12% is uncollectible. So what's 12% of 121,600? Anybody have that calculated? 12% of 121,600.
14,502.
Very good. 14,592. How about 30% of 96,500?
$28,950.
Very good. 28,950. Thank you. Bless you. And then days over 90 days past due, we have 66,000. What's 75% of that?
49,000.
Perfect. Thank you. 49,500. So this is just a way, like I said, we call it aging of receivables. And it's a good estimate. Again, it is still an estimate, though, of how much of our current accounts receivable will be uncollectible. So to figure out my adjusting entry amount, I'm just going to add all of those up. Okay, just add all of those up, and then whenever you get an answer, feel free to just shout it out to me. So if I add all of those up, what is my total allowance for doubtful accounts balance?
106, 106.
Very good. So 106, 106. So $106,106. Again, we just added all of those up, all 5 of those up. And that would be the amount for my allowance for doubtful accounts for the year. Okay. So that's how we do an aging of receivables. Not too bad, right? Just doing some simple math, multiplying and adding. Any questions on that one? That's pretty easy. Okay, we'll move to next. Okay. So here we're actually looking at adjusting for uncollectible accounts. So we did that. We just calculated Evers Industries has computed that the proper balance for allowance for doubtful accounts at July 31st is 106, 106. So we just calculated. I like it when it works that way, right? This is actually going to be July. So what that means is we want our ending balance at the end of this year to be 106, 106. That's what we call like our desired ending balance or our calculated ending balance, however you want to look at it. That's what we just calculated in that aging of accounts receivables. But we know allowance for doubtful accounts is a permanent account. So as we saw when we were looking through writing off, it just continues to have a balance all throughout the year. We start with the credit balance when we do an adjusting entry at the end of one year. And then all through the next year, we're debiting off direct accounts. So allowance for doubtful accounts is changing. So at the end of this year, it could have a credit balance or a debit balance. Okay. So in this case, it tells us we have a credit balance, an existing credit balance of $8,240. So $8,240. This is our balance before adjustments. Okay. So at the end of the year, we're ready to do our next adjusting entry, which they said was July 31. Okay. We have an existing balance and allowance for doubtful accounts of $8,240. We want to have a balance of $106,106. So what do I need to credit allowance for doubtful accounts to get to this balance? Well, how do I calculate that? Very good. I subtract, right? I want this credit, but I have an existing credit. So when you have an existing credit and allowance for doubtful accounts, you're going to take your desired ending balance minus the balance before adjustments. So how much is my adjusting amount? Very good, 97,866. Okay. Okay, so I'm going to debit bad debt expense, 97,866, and credit that same amount to allowance for doubtful accounts. Okay. So when we use an aging of accounts receivable method, when we come up with that ending amount, the 106,106, that's how much we want as our ending allowance for doubtful accounts. So this is what we solved when we did our aging of accounts receivable. However, we already had 8,240 in there from last year. You know, we overestimated a little bit, which is fine. So we don't want to keep adding to that because it's all permanent. Accounts receivable is a permanent account. So this 8,240 that's left in here is still part of the old accounts receivable from last year. So if we just kept adding 106, 106 in the next year, eventually that allowance for doubtful accounts would get too large. Okay, it's not accurate. So that's why when we use an allowance method, we have to look at, when we use allowance like the aging of accounts receivable, we have to consider what's in this allowance for doubtful accounts balance. Okay, so that's the tricky part of Chapter 8. So I would just make a note, when we use the aging of receivables method, you have to consider the allowance for doubtful accounts balance. Okay. So in this case, we had an ending credit balance and allowance for doubtful accounts. So we didn't write off as much to bad debt as we estimated we were going to in the year, which is fine. That's a good thing, actually. It means we collected more than we thought. Okay. So now we have a new ending balance. So this was the adjusting amount. Because we had an ending credit, we subtracted to get that adjustment. So I debit bad debt expense 97,866. And I credit allowance for doubtful accounts 97,866. Are there any questions on that? Okay. Okay, well, go ahead and click next. And here we're really looking at another example with it all together, so we can kind of just practice. So it says, Outlaw Bike Company is a wholesaler of motorcycle supplies. An aging of the accounts receivable on December 31st and a historical analysis of the percent of uncollectible accounts in each age category are given below. So they're just showing us at the end of the year, December 31st, our accounts receivable balance is $1,401,800. Okay, and then they're showing, you know, not yet past due, $892,000. We estimate 0.75% of that is uncollectible. So again, kind of what we already did in 2 examples ago. They did the aging of accounts receivable. So they did it all for us. They showed us all the different balances, the percent uncollectible, and the total amount. So it shows us our total accounts receivable is $1,401,800. Of that, we estimate uncollectible to be $63,410. Okay. So what that's saying is, let me erase this. So what we just solved for was our ending balance. So we want our allowance for doubtful accounts, we wanted to have an ending balance of 63,410. That's what our aging of accounts receivable solved for. Okay. What we want to figure out is how much do I need to credit allowance for doubtful accounts? How much do I need to adjust to get to that balance? And they tell us, assume the allowance for doubtful accounts for Outlaw Bike had a debit balance of $5,140. So this was before adjustment. Balance before adjustment. So in this case, this past year, I wrote off more bad debt than what I had estimated. Okay. So now, out of what's still owed to me in accounts receivable, I want my allowance for doubtful accounts balance to be 63,410. Well, it has an existing debit balance of 5,140. So how do I calculate my adjustment amount?
You subtract.
You don't subtract in this case. You're actually going to add. When it's a credit, if this was a credit balance, we would subtract to get that adjustment amount.
You subtract 5,140 by 63,000.
You're going to add them.
Oh.
And the reason for that, that's where it gets kind of tricky, right? If this was over here as a credit, we would subtract. But since it's a debit balance, we have to add. Okay? So if allowance for doubtful accounts has an existing debit balance, I'm going to add that to my desired ending balance. Okay? And when I do that, what does that give me? 550, 68,550. Thank you. I'm doing math in my head. Sometimes it works. I didn't write that very clearly. 68,550. So I'm going to debit bad debt expense and credit allowance for doubtful accounts, 68,550. Okay. So the reason for that is I'm balancing a T account. So to get to 63,410, well, if I do an adjustment of 68,550, I'm going to subtract out that debit, right, to balance it. So 68,550 minus 5,140 equals 63,410. Okay, so that's why when I have a debit balance, I have to add my desired ending balance plus my debit. Okay. So you're kind of working backwards, in a T account. So if it had an existing credit balance, I subtract. If it has an existing debit balance, I add. And that's what I would put in as my adjusting entry. I would do a debit to bad debt expense and a credit to allowance for doubtful accounts, 68,550. Any questions? You guys are very quiet.
Can you repeat that again? If it has a what account?
Sure. So when you figure out your desired ending balance, to figure out your adjustment amount, if allowance for doubtful accounts has an existing credit balance, you're going to subtract. If it has an existing debit balance, you're going to add. Okay, so in this case, we would take our desired ending balance plus our debit balance to get this adjustment amount. Okay, so that's a good thing to have in your notes. Allowance for doubtful accounts has an existing credit, subtract from your desired balance. If it has an existing debit balance, add to your desired balance. Guys have any questions? It's the trickiest part of chapter 8, so feel free to ask me questions. That's what we're here for, right? So we're good? Okay. Like speak now or forever. No, I'm just kidding. We'll have more time for questions. Yes. For the balance? Sure. For just like when you add or subtract? Sure. So if allowance for doubtful accounts has an existing credit, you will add that to your desired balance to get the adjustment amount. Okay. So if allowance for doubtful accounts has an existing credit, add that or subtract that from your desired balance to get your adjustment amount. I think I said add in there, didn't I? I apologize. See, I'm trying to confuse you all as we go. So if allowance for doubtful accounts has an existing credit, subtract it from your desired balance to get the adjustment amount.
And there's no way to see that in the actual chart. That's just going to be in
the wording.
In the wording.
Yes. What you'll do first is in that aging, what you're solving for is the ending balance. When you do an aging of receivables, you're solving for what you want in this desired ending balance. Okay. And then if you have an existing credit, which they told us, in this case we have a different balance, you'll subtract from your desired balance to get your adjustment amount. And that adjustment amount is what I'm debiting to bad debt and crediting to allowance. In this case, we had an existing debit. So I would take my existing debit plus my desired balance to get the adjustment. Okay. So step one is always solve for your desired ending balance first. And write your T accounts. I always stress that in college accounting. I mean, I use T accounts in upper level accounting because it's a good way to visualize what's going on. Okay, you can see, okay, this is here, this is here, this is how I get there, okay? So I encourage you to use T accounts, bring scrap paper for tests, use scrap paper with quizzes, or pull up a note, Excel file, something, whatever you want to do. But, jot down those T accounts because it makes it easier to see what's going on. You'll have less chance of error if you write down the T accounts. Any other questions? You guys feeling okay? Okay. So that, like I said, this is the bulk of, chapter 8 when we're dealing with different write-off methods. And I guess I thought I did, but I guess I didn't. I think the rest of mine are notes. The other method that I think I forgot to do an example on was just the percent of sales method. So I'm just going to talk just briefly about that. The end goal, if they tell you instead of using that aging of receivables, they can use what's called a percent of credit sales method to calculate this, okay? So if you use percent of credit sales, it's actually the easiest one. So if they say, let me just give you an example. I'm just going to make one up. So say at the end of the year, we had 100,000 of credit sales. And they tell us we estimate 1% of those credit sales are uncollectible. Well, what's 1% of 100,000? 1,000, good. So that's how much we deem uncollectible in the current year, which is really low, I know, but it's just making it easy. When you use percent of sales, so we're just going off of percent of credit sales, that's for this year only. Credit sales are just from this calendar year, right? Sales is a temporary account. So we're only looking at the sales for this year. So this amount that you estimate here goes straight into a debit to bad debt expense and a credit for allowance for doubtful accounts. Okay. So if they say they use percent of sales method, you don't have to worry about what's already in allowance for doubtful accounts. So in the last example, you know, this was what, 5,140 debit balance. Wouldn't matter. I would just say, okay, well, I'm crediting this 1,000. Okay. And then obviously that would, you know, be a debit balance still, which would, it threw it off, but you get the idea. Basically, the big takeaway is if they tell you percent of credit sales, you'll just calculate the percentage and that will be your adjustment amount. Okay. So under percent of sales, you don't have to worry about your balance and allowance for doubtful accounts. So if you see that on the homework, which I'm pretty sure you have one, or on the quiz or test or anything, if you're using percent of sales, don't worry about the balance and allowance for doubtful accounts. Whatever percentage you calculate is what you're going to write off to bad debt expense. So it's easy. We like percent of sales. And the reason behind that is, again, you're doing a percent of credit sales. That's only the sales for the current year. So you're not, you know, there's no sales that could be from previous years. When you're doing an aging of accounts receivable is a permanent account. So you could have money owed to you from like 3 years ago in that account. Hopefully you've written it off, but theoretically, you could have accounts receivable owed to you from previous years. That's why we have to consider what's in here. Any questions on that one? So when you come across a percent of sales, you'll just take whatever percent they tell you, and that's what you'll do, your bad debt expense, debit, credit to allowance for doubtful accounts. Really easy. The only thing that gets people confused is they'll tell you how much is in here, and you'll just disregard it. So they'll try to trick you, okay? If you get on the homework, they're gonna be like, oh, and your allowance for doubtful accounts balance is 5,000. And if it's percent of sales, you don't worry about it, okay? Don't let them trick you. I'm not trying to trick you on purpose, but it's the homework. No, I'm just kidding. But it's good to know that. Okay. So before we move on to notes, are there any questions about uncollectible accounts at all? The direct write-off method, percent of sales, aging? Anything so far? Okay. So moving on. The next part of the chapter, again, talked about notes receivable. So again, a notes receivable can be issued for two reasons. It could be someone borrowing money from us, so we're actually giving them cash, or we could be taking their past due accounts receivable and switching it to a note. So they could say, hey, you know, I have 30 days to pay my account. It's like day 31, and I can't pay it. So like, no problem, we'll give you 90 days more, but we're switching it to a note, and you're going to have to owe us interest, okay? So a notes receivable, if you remember, is more like, from a legal standpoint, it has a little more weight to it because we're actually making them sign a promissory note. So it says, you know, you owe me this much money by this day, and this much interest will be paid. I'll get the words out eventually. So that's the difference between a notes receivable and accounts receivable. So notes receivable bears interest. We earn interest. So they owe us, they pay us interest. Okay. So with a note, we have different items we look at. We look at, you know, the principal amount of the note, which is how much it's written for. We're going to look at the due date of the note. We're going to calculate interest. And so then we're also going to calculate the maturity value. We're going to look at all these different aspects. Okay. So here it says Valley Designs issued a 120-day 5% note for $60,000 dated April 15th to Bork Furniture Company on account. Okay. So when we write that note, I'm going to skip around just a little bit because I just like to, I guess. But I'm going to go down to C1 where it says journalize the entry to record the receipt of the note. So the day that we issue this note, I'm going to issue it just like I would an accounts receivable. So I'm going to debit notes receivable, though, it's the only difference, for the face value, the $60,000. So $60,000. And then I am going to, in this case, it was on account. So since it was on account, I'm going to credit their accounts receivable. So we didn't loan them money, it was actually on account. So I debit notes receivable and credit accounts receivable Valley Designs. Okay. So now what I'm going to do is I want to calculate the due date of the note. Well, you can work through it different ways, but the best way, so we have April 15th, right? So this was written April 15th. So for April, how many days? There's what, 30 days in April? So how many days are left in April? 15. And we're trying to get to 120 days total. And so then we have May, which has how many days? 31, good. So I'm going to add that. So now we're up to like 46. And then we have June, which has what, 30? Okay, so now we're up to 76. And then we have July, and how many are in July? 31, good. It's August 13th. Thank you. And so now we're up to 76, so now we're up to like what, 107? So that's 107 days. So then we move into August. So 120 minus 107, this would come due on August 13th. Okay. So however you want to get to the days calculation. There were 15 days left in April, 31 in May, 30 in June, 31 in July. So that got us to 107 days.
Isn't it a calendar thing on the computer?
Yes, yeah, if you click on like the date and time, it'll pop up your calendar. And so yeah, you can actually look at calendar days and count if you want. Okay, so the due date of the note is August 13th. Okay. When this note is due, we have what we call a maturity value. The maturity value of the note is the face value of the note plus interest. Okay. So to calculate interest, we always take the original amount of the note, the $60,000, times the interest rate, which was what, 5%, times the time in days. So in this case, it's 120 days divided by, we're going to use 360 days. Again, that's that banker's rule. So we're going to take 60,000 times 5% times 120 over 360. So how much interest will they owe? $1,000, good. So $1,000 of interest will accrue. So that's the interest. So the total maturity value is the $60 plus the $1,000. Okay, so the maturity value of the note is how much they owe when the note matures or comes due. Maturity date is the due date. Okay. So to figure out the maturity value, we have to calculate the interest and then add it to the original face value of the note. So $60,000 they owe us for the note itself, plus the $1,000 in interest. So then, to actually recognize the receipt of the payment, well, they're paying us the full $61,000 maturity value. So when they pay us, on August 13th, we're going to debit cash, $61,000, okay, for the maturity value. Of that, $60,000 is going to be credited to notes receivable, just to clear off that note. And the other 1,000 gets recognized as a credit to interest revenue. So we made $1,000 in interest, and that gets credited to interest revenue. The cash is debited for the maturity value. Notes receivable is credited for the face value of the note, the $60,000, and then interest revenue gets credited the $1,000. Okay. So to calculate interest, you're always taking the face value of the note times the interest rate times the time and days. And the reason for that is that 5% is an annual interest rate. So they would owe us 5% interest if they borrowed $60,000 for one whole year. So we're only calculating, we just want to charge them 120 days worth of interest. So that's why we always multiply it by the time. Okay. So basically a third of a year, right? So they're owing us 1/3 of a year of interest. Any questions on calculating maturity dates or values or journalizing that? Okay. Well, let's go to the last example. It's another note. We're just looking at accrued interest. Okay. So on this one, in 2017, we, on December 7th, received from Unitarian Clothing on account a $75,000, 60-day, 3% note dated December 7th. Okay. So when we first issued this note, it was for $75,000. It was on account, 60-day, 3%. We want to journalize that entry, so I'm just going to break it down one at a time. So when I first issued that note, what do I debit and credit to issue a note on December 7th? Notes receivable, good. And what gets credited? Accounts receivable. So I debit notes receivable for $75,000, and I credit their accounts receivable for $75,000. Now here what happens is we issued the 60-day note on December 7th. We could calculate the due date, but they kind of give it to us here. So 60 days, the due date becomes February 5th. Well, that goes into next year. Okay, that's fine. But the problem is we need to report any interest revenue that has accrued in the current year. We need to recognize that revenue in this current year. Okay. So if you remember from college accounting, we had the revenue recognition principle. And it states any revenue earned in the current period has to be reported in the current year. So we issued this note on December 7th. The end of the year isn't until the 31st. Okay. So we have what? 31 minus 7. How many days of interest have we accrued there? 24. Very good. So we have 24 days of interest that has accrued on this note that we've earned. We've earned that interest revenue. We're just not going to get paid for it until February 5th. But we've earned it in the current calendar year or fiscal year. Okay. So what we have to do at the end of December is we have to do an adjusting entry for any interest that has accrued in this current year. So that's 24 days of interest. So first we have to calculate, well, from the 7th to the 31st, that's 24 days of interest. And then we're just going to calculate it. So we would take 75,000 times, what was it, 3%, times 24 days over 360. Very good. $150 of interest has accrued as of December 31st. So what we need to do there is we're going to debit interest receivable because it's interest due to us that we're not yet getting paid for $150, and credit interest revenue, recognizing that we've earned $150 of revenue. Okay, so that's the adjusting entry for interest accrued but not yet received. And then they throw a really fun one at you, right? Good review. They say record the closing entry for interest revenue. Well, if you remember, at the end of the year, we had to close all of our temporary accounts. Okay, revenue is a temporary account. Revenues, expenses, and dividends are all temporary accounts that all get closed into retained earnings. Do you guys remember that, doing that vaguely in chapter 4? So what we're going to do is we would close interest revenue. Well, it has an existing credit balance, so to close it, we would just debit it. Okay, so I'm going to debit interest revenue. And if you remember, that got credited into income summary. So that's just a little bit of a going back.
Why did it go to income summary?
When we did closing entries, what we did is we closed all of our revenues by crediting them to income summary, which is really just like a placeholder account in the closing process. So all revenues get credited to income summary and expenses get debited to income summary. And then at the end, your income summary balance would be your net income. And then that gets closed into retained earnings. Is that kind of, yeah, I know it's been a while. And so yeah, just as a review. So income summary, all of your revenues got credited, expenses got debited. The income summary ended with a net income balance. And then furthermore, that went into retained earnings. So retained earnings, then net income got credited, dividends got debited, and you would balance it. So that was just what we did in chapter 4 in the closing process. I know it's been a while. So the end goal was to close all of those accounts into retained earnings. So net income increases retained earnings, dividends decreases it, get a balance. Any questions on that part? I know that's going back a few months, so. Or years, you know, however long. Yeah. You know, could be some time has passed, so. And then the last thing we do on February 5th is we receive the full payment of the note and interest. Well, we would need to calculate the full interest amount. So we would also, you know, do that. We would take 75,000 times 3%. I'm just actually going to take the remaining. So how many days? It was 60 days, right? So we had a remaining 36 over 360. So the remaining interest due on this note was $225. Okay, so we've already recognized $150 of revenue. But since it was a 60-day note, I still had 36 days left of interest to calculate. So that would have been another $225 of interest I haven't yet recognized. So all total, they owe me $75,000 plus $150 plus $225. Total interest, you know, is the $375. So how much am I receiving from them in cash on February 5th? Very good. $75,375. So the original face value of the note, the $75,000, plus all of the interest, 60 days worth of interest that has accrued, which is $375 of interest. Notes receivable, gets credited the 75,000 original amount. And then I'm going to credit interest receivable for 150. That adjusting entry I put in up here on December 31st, I debited interest receivable. Well, now they're giving me that 150, so I'm crediting it because they're paying it off. And then I'm going to credit interest revenue, the remaining $225. So the interest that has accrued from January 1 to February 5th, those 36 days. Question? Okay. So that one gets a little trickier because we've already recognized, $150 of revenue in interest. So now they're paying us the full amount. Question? Any questions on a note that has an adjusting entry for accrued revenues at the end of the year? Okay. So we only have to do this when we span over 2 fiscal years. Okay. So the note was written in 1 fiscal year and it's due in the next fiscal year. So that's why we have to do that interest adjustment.
Like on December 31st, we adjusted, and then on December 31st, we closed.
Uh-huh.
Was that in the same day?
Yes. Yeah, we'll do all of our adjustments and all of our closing entries at the last day of the fiscal calendar.
So why do we switch them as if it was like day? Or I don't know, because it was interest receivable, debited, and then it was revenue credited, and then to close it, it was changed. Like it's the opposite.
Well, what you're doing, the adjusting entry is recognizing interest revenue that was earned in this year, right? And then in that closing entry, if you remember at the end of the year, we close all of our revenues, all of our expenses. So that's just closing, that's just one piece, one entry of all the closing entries we would do. So that's just showing closing that one interest revenue account. We'll have like fees earned or sales or something else for closing. And
so making like the balance zero kind of?
Yeah.
Oh, okay.
Yeah, when we close out, because revenue, expenses, and dividends are all temporary accounts. So at the end of the fiscal year, we zero all of them out. Bless you. Okay. Any other questions? Any questions on Chapter 8 so far? All right, let's see. Stop this.